Welcome to our in-depth tutorial on credit risk, an essential aspect of finance that impacts both lenders and borrowers. Today, we will dive deep into what credit risk is, why it matters, and how it is managed. We'll also review real-world examples and data to help you understand this concept thoroughly. Credit risk is the risk of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. This can stem from a delay in repayments or outright default. Simply put, it is the possibility that a borrower won't pay back a lender as promised. There are several types of credit risk, including default risk, credit spread risk, and downgrade risk. Default risk is the most straightforward type, representing the risk that a borrower won't make the required payments. Credit spread risk involves the risk of changes in the difference, or spread, between the yield on a corporate bond and a government bond. Finally, downgrade risk occurs when a borrower's credit rating is downgraded, increasing the cost of borrowing and signaling higher risk to lenders. Let's look at how credit risk is measured. Lenders evaluate the creditworthiness of borrowers by examining their credit scores, financial statements, and other financial indicators. Credit score models like FICO consider payment history, current debt levels, length of credit history, new credit accounts, and types of credit used. One common method used in credit risk analysis is the Z-score, a statistical measure that quantifies the probability of a firm going bankrupt. The formula is Z is equal to 1.2 times 1 plus 1.4 by 2 plus 3.3 by 3 plus 0.6 by 4 plus 1.0 by 5. Where XS represent various financial ratios such as working capital/total assets and retained earnings/total assets. Let's take a moment to address some common questions. One frequently asked question is, can a high credit score entirely eliminate credit risk? The answer is no. While a high credit score significantly reduces credit risk, it does not eliminate it. Economic downturns, unexpected personal financial crises, or other unforeseen events can still lead to defaults. Now, let's look at a real-world example. During the 2008 financial crisis, numerous high-rated mortgage-backed securities defaulted, highlighting the unreliability of ratings alone in assessing credit risk. Analysts were overly optimistic about the property market, failing to account for a widespread market downturn. Credit risk management involves several strategies such as diversifying the loan portfolio, setting credit limits, requiring collateral, and conducting ongoing credit assessments. Another crucial aspect of managing credit risk is monitoring economic indicators that may affect borrowers' ability to pay. Let's explore some data to understand the impact of credit risk better. For instance, let's consider the default rates of corporate bonds over various periods. In this graph, we see that the default rate for corporate bonds increases significantly over time, highlighting the importance of long-term credit risk assessment. For example, the default rate for corporate bonds is only 1.1% over 1 year, but rises to 7.2% over 10 years. Another question we often get is how different industries are affected by credit risk. Industry-specific risks play a significant role in credit risk assessment. For example, the technology industry may have higher volatility compared to the utility sector, which typically has more stable cash flows. Understanding macroeconomic conditions is vital for credit risk management. Factors like GDP growth, unemployment rates, and inflation can significantly impact borrowers' ability to repay loans. For instance, during periods of high unemployment, borrowers are more likely to default on their loans. Let's examine some macroeconomic data. Here is a line graph showing the correlation between GDP growth and default rates over the past decade. From this graph, we can observe that default rates tend to increase during periods of low or negative GDP growth, such as during the 2020 pandemic-related economic downturn. Conversely, default rates are lower when GDP growth is strong. Another important question is, how do lenders protect themselves against credit risk? Lenders use a variety of tools and techniques. For example, they might purchase credit default swaps, which act as a form of insurance against borrower default. Let's dive into a more advanced risk management concept, Credit Valuation Adjustment, CVA. CVA is the risk of counterparty default, affecting the market value of a derivative instrument. It is calculated based on the difference between the risk-free portfolio value and the true portfolio value that considers the possibility of a counterparty's default. To wrap up, credit risk is a multifaceted aspect of finance that requires a comprehensive understanding and ongoing management. It's not just about assessing the borrower's ability to repay, but also about understanding broader economic indicators and applying robust risk mitigation strategies. Thank you for joining us in this detailed exploration of credit risk. Stay tuned for more finance tutorials, and don't forget to like, share, and subscribe.